So question number 7 is on beta management. You all should remember that beta management is a very important topic, and this topic actually is featured in our syllabus at two places. Once in the portfolio management chapter and once more in the derivatives chapter. In derivatives chapter, we do beta management by using stock index futures. I hope you remember, for example, if we want to reduce the beta of the portfolio because market is expected to fall, we sell stock index futures. And we want to increase the beta of the portfolio, we buy stock index futures. That is what we do in derivatives. In the portfolio management chapter, we do the same thing by investing or short selling RF. It's commonsensical approach that if you put some money in RF, your beta will come down because RF has a beta of 0. On the other hand, if you disinvest in RF, that means you short sell government securities, obviously beta will go up. So beta management can be done either with the help of stock index futures, which is a much more important topic in derivatives, we'll do it later. And secondly, in portfolio management by buying government securities or by short selling government securities. So I've taken some time to explain to you that both the types of sums are important. Look at all the types of sums and all the specific sums are there. I think altogether you will come across around 10 or 12 sums that are there on beta management. Very, very important. Okay. So coming to this sum, you can see on the screen question number 7. A portfolio manager has the following 4 stocks in his portfolio: VSL, CSL, SML, APL. Number of shares, market price, beta. Any student of SFM, as soon as he looks into the table, he jumps to calculate weighted beta. Okay, you know weights being the market value. So basically, question number 1 is calculate the portfolio beta. I don't need to teach you still. You have to make a column for market value, which is number of shares into share price. That means 10,000 into 50, 5,000 into 20, 8,000 into 25, 2,000 into 200. Now they are the weights. But the CA Institute in its past solution, rather than giving that market value as the weight, they compute weights on the basis of market value. They compute weights on the basis of market value understanding. For example, 10,000 into 50, that is 5 lakh. So they will not take 5 lakh as weight. They will take 5 lakh divided by total portfolio as weight. No issues. We can calculate that weight just to make them happy. So you may have a column for market value, then a column for weight. And then beta is there and then weighted beta. Okay, even though there's no need for me to show the solution, let us look at the solution. So if you look at the solution before you, they have a column for security, number of shares, market price, 1 into 2 is market value, then weight, and then beta, and then WX. And they got 1.108, portfolio beta 1.108. That's the first part. So the portfolio is slightly aggressive, 1.108. That means if the market changes by 1%, portfolio will change by 1.108%. Let us come back to the question. Second part of the question. If the portfolio manager seeks to reduce the beta to 0.8, how much risk-free investment should he bring in? If the portfolio manager seeks to reduce the beta to 0.8, how much risk-free investment should he bring in? So our beta was 1.108. We want to reduce it to 0.8. Hope you are sitting with the calci. So if you want to reduce it to 0.8, you have to invest in RF. So simply you have to do what? Since the weight of RF, since the beta of RF is 0, basically if you invest at 1.108 and 0 beta, you got to get weighted average 0.8. So the weight of the portfolio should be 0.8 by 1.108. 0.8 by 1.108. Those who want to mug up, weight of the portfolio will be your target beta divided by existing beta. Those who want to mug up, okay, like people mug up the practice manual, na? So if you want to mug up, otherwise it's common sense. So 0.8 by 1.108. 0.8 by 1.108 is what percent? 0.8 by 1.108 into 100 is what percent? It is 72.2%. 72.2%. I'm doing it on calci right now. No need to look into the solution. So that means this portfolio should be 72.2%. That means we can find out the total portfolio, as in this portfolio. What was the value of the total portfolio? Let's check. I'm going to the solution. So in the solution we find the total was 12 lakh. Okay, the total was 12 lakh. So 12 lakh is 72.2%. So what is the total portfolio? 12 lakh by 0.722 12 lakh by 0.722, I'm looking at the solution. The 12 lakh by 0.722 is 16 lakh 62,050. So total portfolio should be 16,62,050, out of which 12 lakh is already invested in these 4 shares. So the remaining amount, 16,62,050 minus 12 lakh, that is 462,050, shall be investment in RF. It is there on your screen. You can see 462,050 shall be the investment in RF. Investment in RF 462,050. And then they have the patience to once again show that we reached the beta. So look, they prepare one more table, and in that table the 4 securities, VSL, CSL, SML, APL, okay, the risk-free asset. Now what they have done, since we are investing 462,050, so they have assumed that we are investing it at the rate of 10 rupees. So in the number of shares in the table, they have taken 46205. And in the market price, they have taken 10. Anybody can complain, sir, how did we get 10? They got it from ghar se, ghar ka kheti. That's what we say in Hindi. Okay. So you can also just appease them, make them happy by following this, that 46205, remove a 0. So 46205 is the number of securities at the rate of 10. And its beta is 0 in the second last column. And accordingly, we calculate the weighted beta. We prove that it's equal to 0.8. Okay, we prove that it's equal to 0.8. Let's get back to the question. Third part, if the PM seeks to increase the beta to 1.2, this time we want to increase the beta to 1.2, how much risk-free investment should he bring in? So the weight of the portfolio will be the target beta 1.2 divided by the existing beta 1.108. So 1.2 divided by 1.108, calci please. 1.2 by 1.108 into 100, that's coming to 108.3%. 1.2 by 1.108 into 100, that's coming to 108.3%. So that means 12 lakh is 108.3%. So please divide 12 lakh by 108.3%. 12 lakh divided by 1.083. Let's look at the solution. We look at the solution. So 12 lakh by 108.3%, and that comes to 11,08,033. 11,08,033, say 11,08,030 they are saying. So the portfolio value should be 11,08,030, but we already invested 12 lakh. So that means we have to disinvest. That means we have to short sell RF to the extent of 12 lakh minus 11,08,030. That means 91970 negative. So we have to short sell RF to the extent of 91970. It's not invest, it's divest. 91970. Okay. I had done this question in class also. And obviously once again they have a table for it. They have shown the revised portfolio. VSL, CSL, SML, APL. Risk-free asset, it was 91970. So they have taken minus 9197 at the rate of 10. Okay. And they proved that we got a beta of what? 1.2. Okay. So that is the answer. Perfect. Thank you. Okay, let's come to question number 9. Question number 9 is that age-old ambiguous sum, but this time it is a little bit changed and improved. I mean to say ambiguity is still there, but it is less as compared to what it earlier used to be. So beware please. This is not the same sum that we had done in which GOI bonds have a beta of 0. Let's see. Suppose one of your HNI clients is holding the following portfolio as per his risk appetite. There are 3 shares, G, S and B. We also have PSU bonds. The number of securities that we have is 1,000, 1,500, 20,000. The second table. The other data related to each of these securities as follows. The cost, that means the cost per security. So you have to multiply the security 1,000 into 10,000, 1,000 into 15,000, 500 into 28,000, 20,000 into 1,800 in order to get the total cost that was applied to the 4 securities. Dividend is given, obviously that's also per unit, and market price is given. So one can, for example, calculate the price appreciation or depreciation per unit. For example, the first security G, the price has fallen from 10,000 to 9,800. That means minus 200. In the second one, 15,000, 16,200. That means 1,200 positive. Third one, 28,000 to 28,300. 300 positive. Fourth one, 1,800 to 1,725. It's 75 negative. So you find out the capital gain loss per unit. Now the dividend plus the capital gain. Dividend plus the capital gain is the total income per unit. You multiply that total income per unit with the number of units. For example, in the first security, 1,725 is the dividend and the capital loss was 200. So 1,725 minus 200 is what? 1,525. So 1,525 you gained per unit. So 1,525 into 1,000. Okay, that's the total gain. So that way you find out the total gain for each security. Okay, so you find out the total gain in that column. Okay, now I'm not saying further what to do. Let's read the question. Your client is interested in investing some more funds in bonds issued by GOI. Some more funds to be invested in GOI. Okay, risk free. Estimate the minimum rate of return that your client would expect from these bonds, that means GOI bonds, keeping in view his risk appetite and assuming market return 12.7%. So we are supposed to find out the rate of return from GOI, that means RF, given that RM is 12.5%. Okay, so 12.7%. So we are supposed to find out RF. So let's be very patient. I'm not going to the solution right now. In order to calculate RF, we require in CAPM, RP is equal to RF plus RM minus RF into beta. RP is equal to RF plus RM minus RF into beta. Even though I am not showing the formula on the screen, but if I have to show you CAPM formula on the screen and the exam is 1 month from now, I think I should better not teach this. So RP is equal to RF plus RM minus RF into beta. So you have RM, you need RP and beta, so that you can put RP and beta and you can solve for RF. Okay. Now, as far as RP is concerned, we already calculated the gain on each stock. Okay, like the dividend plus the price change, the whole multiplied by the number of securities. So you got the gain in each stock. You add up the gains and you divide by the total cost, and you get the return on the portfolio. Okay. Let me show the solution. Let us come to the solution. So we are coming to the solution. So in the solution, if you see, they have taken cost, number of securities, multiplied that, they got the total cost, dividend is given, capital gain, then the dividend and capital gain is the net gain, multiplied by the number of units. They got the net gain on each security, 15 lakh, 25,000, 22 lakh, 8 lakh 50, 21 lakh, total gain 66 lakh 75,000 by investing 7 crore 50 lakhs. So let's check. So what's the return they have calculated? 66 lakh 75,000 divided by 7 crore 50 lakhs. That's 8.9%. This is RP. This is what? RP. Let's come back to the question. So you come back to the question. Okay. We come back to the question and we find that in the question, beta is given in the last column. Now, if you remember the old sums of this type, there was a huge debate in class because the institute had calculated beta in these types of sums as average beta, as in add up the 4 beta and divide by 4. But in this sum, I said they have improved. So they have not calculated the average beta. Instead, they have calculated weighted average beta. And then you will feel that the institute is so smart nowadays. No, the weights that they have used is the cost. Whereas beta is always calculated with the current market value as weight. So they've used the cost. Cost does not mean the 10,000, 15,000. Cost means the amount, the total cost. That is the cost into securities that was invested. So that is the basis of the weights. Okay, the total cost that was invested. For example, in the first security, we had purchased 1,000 units at 10,000. So that total 1,000 into 10,000 is the weight. Similarly, second, third, fourth, and you have the beta. So they've calculated weighted average beta using cost, total cost as the weights. Okay, total cost as the weights. Let's see the solution. So in the solution, we find that the weights that they have used to calculate beta, okay, are 1 crore, 1 crore 50 lakhs, 1 crore 40 lakhs, 3 crore 60 lakhs. They are the weights that they have used. Let's check it out. There's a column now. If you check in the table, there's a column 6 into 3. That column 6 into 3, that means beta into total cost. So that column is 3 crores and that divided by 3 crores or whatever amount, that divided by 7 crore 50 lakhs. So that gives a beta of 0.4. So they've got a weighted average beta of 0.4. Now we have the beta of 0.4. I'm looking at the solution and we have the RP which is 8.9. We have the RM which is 12.7. So RP is equal to RF plus RM minus RF into beta. You put the figures and you get beta is equal to, you get RF is equal to 6.37% answer. So RF is equal to 6.37% answer. 6.37%. Okay, let's get back to the question. So if we get back to the question, analyze whether his portfolio has outperformed the market or not, assuming risk-free rate of return is 7%. The portfolio has outperformed or not, and this time RF is given 7%. So if RF is given, RM is 12.7 and beta was 0.4, we can calculate RE. Okay, 7 plus 12.7 minus 7 into 0.4. Please calculate on the calci. Okay, I'm not going to the answer. 12.7 minus 7 is RM minus RF. 12.7 minus 7. What's that? 5.7. That into 0.4 beta. 5.7 into beta plus 7. Plus 7. That's coming to 9.28 on my calci. So 9.28 is the required rate of return. Whereas the expected rate of return was like 8.9%. So expected is less than required. So our portfolio has underperformed. Okay, let's check the solution for formality purpose. So that's what they have done. They have called it expected return. That's wrong language. It's required rate of return. 7 plus RM minus RF into beta 9.28. Whereas the return was 8.9%. So they've earned a lower return. Alpha is negative. You remember alpha. Alpha is negative. That means underperformance. Okay, underperformance. So good sum because it is different from the past sum that we had done in class. So do have a look into it. And if the past sums comes, don't solve it in this manner. You have to remember which sum to solve in which manner. So I don't like this. This is basically mugging up. Yes, you are right. Okay, you like it or you don't like it. We say na beggars are not choosers. Let's come to question number 11. Now question number 11 is on portfolio rebalancing, the formula plan. I hope you remember. Okay, the constant ratio plan, the variable ratio plan, okay, all those plans. So this is constant ratio plan, the sum on constant ratio plan. In fact, this sum is there in our book. It was done in class, but it's very important. So I don't mind discussing with you again, but the discussion would be short and sweet. Okay, let me not read one by one what is given. Basically, this person, Miss Sunidhi, has decided to use a formula plan and compare that with a passive buy and hold strategy. Remember, in the passive buy and hold strategy, the entire funds are invested in the equity, that is aggressive portfolio. While in the formula plan, we invest half in the aggressive portfolio equity and the other half in the conservative portfolio bond. We are given the NAV of the fund, that is the equity, okay, for the last 8 months. Check the NAV. Now, after the table, it's written, assume Sunidhi has an amount of 20 lakhs for investment and she has invested equally in equity fund and a conservative portfolio of bonds in the beginning of December. So 10 lakh, 10 lakh, 10 lakh. 10 lakh aggressive portfolio, 10 lakh conservative portfolio. So if you have the calci, how many units did she purchase? 10 lakh by 40. 10 lakh divided by 40. You can check the NAV, 10 lakh by 40, which is 25,000 units. So she purchased 25,000 units initially. Okay, investing 10 lakh and the other 10 lakh was invested in the conservative bond portfolio. And the portfolio was being rebalanced. It's written over there. The total portfolio was being rebalanced each time the NAV increases or decreases by 15%. So if the NAV changes by 15% up or down, we rebalance. Okay. So if you check the first NAV, that's 40. What is 15% of 40? You can check on the calci. 15% of 40 is what? 6. So basically 40 plus minus 6, we will rebalance. So we find that the next NAV is 25. So obviously 25, we have to rebalance. Okay, let's check further. You are required to determine the value of the portfolio for each level of NAV following the constant ratio plan. Okay, round off the number of units to 2 decimal places. So if I am doing it just verbally, 2 or 3 calculations. So when the price becomes 25, it is a change of more than 15% from 40. So 25, what is the value of the aggressive portfolio? We had 25,000 units. So 25,000 into 25. 25,000 into 25, that is 6,25,000 aggressive portfolio. In the defensive portfolio, we had 10 lakh. So total is 16,25,000. But we need to rebalance. So half of 16,25,000 by 2. 16,25,000 by 2 is 8,12,500. So 8,12,500 should be there in the aggressive portfolio. But there we have 6,25,000. So we need to put what additional amount? 8,12,500 minus 6,25,000 is 1,87,500. I am saying this all from my calci. 1,87,500 we have to invest more in the aggressive portfolio at the rate of 25. So 1,87,500 divided by 25. How many extra units? 7,500 extra units. So the cumulative units becomes 25,000 plus 7,500. 25,000 plus 7,500, which is 32,500. Let's check the solution. So we check the solution. That's what is done. 10 lakh conservative, 10 lakh aggressive, total 20 lakhs. Okay, and 25,000 units. And then the 25,000 units into 25 is 6,25,000, whereas 10 lakh conservative, 16,25,000 half. So 8,12,500, 8,12,500. So we have to buy how much? 8,12,500 minus 6,25,000, the whole divided by 25, which is 7,500 units. So that way you have to proceed. Okay, it's commonsensical. It's commonsensical. That way you have to proceed. Okay, let me go back to the question. So I'm going back to the question. So in the question, we have to rebalance at 25 because it's more than 15% change. Now what is 15% of 25? 15% of 25 is 3.75. So we are waiting for a change of 3.75. The price goes to 36. That's a bigger change. So at 36 also we have to rebalance. You remember how we have to rebalance? If I speak calci wise, we had 32,500 units. So 32,500 units into 36. Let me do on the calci. 32,500 into 36. That's coming to 11,70,000. Okay. Whereas in the defensive portfolio, we have, I think, 8,12,500. I think 8,12,500. So 8,12,500 plus 11,70,000. 8,12,500 plus 11,70,000 is 19,82,500. Now we have to do half. 19,82,500 half. Let me show the figures in the solution. 19,82,500 into half. So if I go to the solution, you can check. At 36, we'll revalue 11,70,000, 19,82,500 half is 991,250. So basically, the aggressive portfolio has to be reduced from 11,70,000 to 991,250. So the difference you have to sell at 36. That comes to 4,965.28 units, and so on. Okay, so this is how you will do the calculation. Let me get to the question once again. So if we come to the question once again, in the question, you have to rebalance at 36. Yes. Now what is 15% of 36? 15% of 36 is what? 5.4. But 36 to 32 is not 5.4. So do not rebalance at 32. Just revalue at 32. Now 32, 15% is what? What is 15% of 32? It's 4.8. So 32 to 38, it breaches 4.8. So at 38, you will rebalance in April. At 38, you will rebalance half. Now, what is 15% of 38? Obviously, it's not 1. So, 37 don't rebalance, 42 don't rebalance, 43 don't rebalance. So, we rebalance only at 25, 36 and 38. Finally, you get the total value of the portfolio at the end. And you have to compare that with the buy and hold strategy where you invest the entire 20 lakh at 40. So, there you invest 20 lakh at 40, buying 50,000 units. And what is the value of the units at the end? 50,000 into 43. 50,000 into 43 in the buy and hold strategy, the entire 20 lakh is invested in the equity. So 20 lakh by 40, 50,000 units into 43. That's coming to 21,50,000. Okay, let's check the answer. So the buy and hold portfolio is 21,50,000. Yeah, 21,50,000. Whereas the ending value of our portfolio in the solution is 21,71,619. So in this case, our constant ratio plan has outperformed the passive buy and hold strategy because the passive buy and hold is becoming 21,50,000. Our mechanical strategy is 21,71,619. Okay, so this strategy has outperformed the passive buy and hold. So let's come to question number 10. Now this is a very simple sum. Asset beta, equity beta. You know asset beta means the unlevered beta. That means weighted average of equity and debt. While equity beta is the levered beta. Asset beta means only business risk. Equity beta means business risk plus financial risk. Imagine the balance sheet. They are saying the total market value of equity is 60 lakh. Imagine the balance sheet, please. 60 lakh on the liability side. Total value of debt is 40 lakhs. Total balance sheet is 1 crore. The treasurer estimates that beta of the stock is currently 1.5. So the 60 lakh has a beta of 1.5. And the expected market return is 16% RM. Treasury bill rate is 8% RF. What is the beta of the existing assets? So, beta of debt is not given. So, we have to assume it to be 0. So, in that case, on the balance sheet liability side, if you are imagining on the balance sheet liability side, we have 60 lakhs with a beta of 1.5 and 40 lakhs with a beta of 0. So, 0.6 into 1.5 plus 0.4 into 0. What is the beta of the portfolio? 0.9. Okay, 0.6 into 1.5 plus 0.4 into 0. 0.9. 0.9 is the unlevered beta, asset beta. Okay, the beta of the entire firm. Estimate the company's cost of capital. and discount rate for an expansion of the company's present business if the same is to be financed by equity only. So you are going to do a new project to be financed by equity only. So if only equity, that means there is no financial risk. We only have business risk. And business risk is captured by asset beta. Okay, not by equity beta. So the discount rate should be the company's cost of capital, which is RF plus RM minus RF into asset beta. That means 8 plus 16 minus 8 into 0.9. 8 plus 16 minus 8 into 0.9. So what does it come to, please? 8 into 0.9 plus 8. 8 into 0.9 plus 8. So that's coming to 15.2%. So 15.2% shall be the discount rate. I hope you're not getting confused. So when do we use the discount rate as RF plus RM minus RF into 1.5? When do we use that? We use that when the project is financed by debt and equity in the ratio of 40-60. Because then business and financial risk both are there. So shareholders will require a higher rate of return. But if we only have business risk because the project is unlevered, it's financed only by equity. In that case, there is no question that we should charge 1.5 beta. We should charge the unlevered beta, which is 0.9. I'm not showing the solution because there's nothing in the solution. You can check the solution at your end.